Hi guys, George here from Infltaion. Today I'm going to talk about the number one thing that I'm getting asked at the minute while I'm out and about talking to people about life insurance and financial protection. If you'd like to see more content from us, then please check out the website. I'll put a link to it down below. There's a whole host of blogs, content, podcasts, articles, all about personal finance, and it's not going to cost you a single penny. We've created a cheat sheet as well that you can download from the website. It's completely free and it's a short document that will really help answer any initial questions that you may have about life insurance. All you have to do, head over to the website, click on the cheat sheet tab and download it from there. So, the number one question that I'm currently getting asked is, George, how long do I need my policy for and for how much cover do I require? Now, unfortunately, I don't own a crystal ball and I'm not magic, so I can't pull that answer out of the hat. The answer isn't all that simple and will 100% revolve around you as an individual, your objectives and some other factors. However, today I'm going to give you a couple of tips and a couple of things that you might be able to think about centering your answer around, and hopefully it might help you. So one thing that a lot of people use and is a complete must in my book is the mortgage. So if you currently have a mortgage of any value and you're not protected, if the worst was to happen, that could leave you in a bit of a mess. I'm going to go a little bit of an aside here and say that we recently interviewed a chap down at the company I'm working for, and his job, he was working for a building society at the time, and his job was actually to ring recently widowed people and unfortunately tell them that their partner or spouse or whatever had no cover, and therefore that actual company was still expecting the mortgage payments, and you know, that was sort of the number one reason why he himself wanted to become a financial advisor, which I thought was, you know, brilliant, because you'd much rather be on the other end of the phone as a financial advisor, picking up the phone and going, don't worry, you know, we'll get the paperwork sorted, we'll move everything forward, and at least you don't have to worry about the financial burden of you know, that kind of scenario. So like I say, mortgage, absolute number one priority. If you have an unprotected mortgage at the minute, sort it out. That's all I'm going to say. There is a specialised sort of thing for repayment mortgages. It's called decreasing term cover, and effectively the actual cover tracks the interest rate that you're paying on your mortgage and therefore decreases over time. So at any point, if you or your partner was to die, your mortgage will be paid off in a lump sum and you wouldn't have to worry about that. The second thing, there's kind of two parts to this one, and we're going to talk about children. Children are expensive, absolutely no doubt about that. I know, because I'm probably still like 45% a child. And this point to start with will not be about a monetary value, but more of like a length of time that you'd hold a policy for. And I use this as a great example. So until children become financially dependent, so I usually use the age right 21, 22 for that child, sort of like a post-university or college age, and they might be in full-time employment and starting having a bit more money come into themselves. The main reason for that is effectively, if you were to die or your partner was to die, you would like your children to have at any point the same standard of living that they're currently having, and you wouldn't like them to suffer financially for that kind of loss. And another thing on the sort of more monetary side of this is how much you decide, you know, what sort of value do you put on that. And so you've got your length of time until your children sort of, you know, finish university or what you know, around that kind of period. Now, a thing I like to use a lot is like a multiple of salary or a multiple of expenses for the year. So, you know, yourself or your partner die, the household income you require for the year, say it's sort of like £20,000, then you say, well, if I want to have the same lifestyle for the next 5 years and not suffer financially for the burden of, you know, someone dying or your partner dying, then you'd want 100 grand to come in. Now there is two options how you can take that. There is one that's sort of like you just get a lump sum, £100,000, you know, and then you can decide what to do with the money, whether you need to pay the mortgage off or, you know, what you feel and want to prioritise the most. And then the second option is something called family income benefit. So effectively, family income benefit is if you or your partner was to die, instead of receiving a lump sum, you would get monthly payments. So again, when using the value of sort of £100,000, what you do is sort of, instead of getting that in one lump sum, and then you don't really know what to do with it because you never really had that kind of money just come into your bank account before. What you do, you choose a value, sort of, you know, might be the mortgage payments and bills and rent and clothes and food and so on, and you sort of get a value for that and go, right, if my partner was to die, I would want that to come in at least, maybe that's sort of £1,000 or £1,500, and you want that to come in every month until your children were no longer financially dependent on yourself, and that's called family income benefit. Like I say, link below, check that out, and yeah, we'll move on to the next tip. Another great way to look at this, and this is also one that I use, is let's say let's paint a scenario. So you're 51 and your partner's 54. They're the main breadwinner. They earn 30 grand a year. You're both looking to retire at 60. So for yourself, you've got 9 years, and your partner, who's the main breadwinner, they've got 6 years to retirement, 30 grand a year. So that's an 180 grand lump sum at this point in time. So what you do, that's the sort of value you choose, and you know the sort of length of time will be to retirement, and that would mean that if your partner was to die at any point between now and retirement, you'd be able to live the same lifestyle. You potentially have a lump sum to pay the mortgage off as well. If you were not mortgage free or had any other liabilities, you could pay those off. But yeah, the main point of this is you wouldn't have to work for longer, work harder currently, because I think personally the worst thing in the world is to have the sort of emotional pain of losing your partner and then going, oh, I've got to work for harder or longer hours than I used to. So the main benefit is the lifestyle that you're currently living. If you calculate the right amount, you can keep up that lifestyle and retire at the same time you wanted to. So that's going to be it from me today. Hopefully it helps you a little bit or gave you something to think about. Please check out the Inflation website. There's a whole host more content and ideas on there. There's a load more videos on this on different topics that explain everything and just drill down a little bit. Check out the cheat sheet as well, like I say, completely free to download. Don't forget to subscribe to our mailing list and subscribe to our YouTube channel to keep up to date with all the sort of personal finance uploads. And that'll be it for me today, so thanks for tuning in, and I'll catch you next time.